If you own an LLC and you're paying yourself the wrong way, you could be overpaying the IRS by $8,000, $12,000, or even $20,000 a year without even realizing it. I see business owners all the time running payroll when they shouldn't, skipping payroll when they legally have to, or taking money out randomly with no tax strategy at all. And in 2026, the IRS has better data matching, more automation, and far less tolerance for mistakes. So if you own an LLC, this information is for you. Hi, my name is Alex. I'm a CPA and I work with business owners every day to help them stay compliant, reduce taxes legally, and avoid the exact mistakes we're talking about today. Before we talk about how to pay yourself, we need to clear up one of the major misunderstandings. An LLC is a legal structure, not a tax classification. So, for tax purposes, an LLC can be classified in a few different ways. By default, a single-member LLC is treated as a disregarded entity. This means that it's reported on your Schedule C of your personal tax return. If an LLC has more than one owner and no election is made, the default classification is a partnership. An LLC can also be elected to be treated as an S corporation or a C corporation. Think of this like a decision tree. Once you know how your LLC is taxed, the way you pay yourself becomes very clear. Let's start with the default classification, disregarded entities and partnership. If you're a single-member LLC taxed as a disregarded entity or a multi-member LLC taxed as a partnership, you do not pay yourself through payroll. There is no W-2, no paycheck, and no salary. Instead, you pay yourself through what is called an owner's draw. An owner's draw is simply a transfer of money from your business bank account to your personal bank account. There is no payroll system, there is no tax withholding, there is no pay stubs. It's just a clean bank transfer. A common mistake I see is business owners calling draws salary in their bookkeeping. That's incorrect, and it can create reporting and audit issues later on. Another critical point, owner draws are not a business expense. Taking money out of the business does not reduce your taxable income, and the business is taxed on its net profit. That means all of its income minus all of its expenses. It's not in how much cash you actually withdraw. This is also why your business must have its own separate bank account. One of the main reasons you form an LLC is to create legal separation between you and your business. When you mix personal and business funds, you weaken the separation and make it harder to defend in an audit or legal dispute. Owner draws should always be documented from the business account to your personal account, clean and intentional. Now let's talk about the taxes. If your LLC is taxed as a disregarded entity or is a partnership, the profit passes through to you personally. You'll generally pay federal income tax and self-employment tax, and state tax if applicable. Self-employment tax is currently 15.3%, which covers Social Security and Medicare. That's the total 15.3%, and it applies before income is taxed. This is in addition to your federal and state income taxes. This tax applies to your net profit, not how much money you actually take out of the business. That's why paying yourself strategically isn't about timing your draws. It's about planning your taxes before the money leaves the account. In 2026, smart business owners treat draws as cash flow decisions, not income decisions. And they're setting aside money for taxes throughout the year. Once business becomes consistently profitable, this is where an S corporation status often comes into the picture. If you elect to be taxed as an S corporation, the way you pay yourself changes significantly. As an S corporation, owners, you are required to pay yourself a reasonable salary through payroll. That means you receive a W-2, you pay payroll taxes that are withheld, and you're treated as an employee of your business. However, and this is the key advantage, only your salary is subject to self-employment taxes. Any additional profits you take out are distributions, and they are not subject to the 15.3 self-employment tax. Let's walk through a simple example. Assume your LLC earns $120,000 in net profit for the year. If the LLC is taxed as a disregarded entity, the full $120,000 is subject to self-employment tax. That's 15.3% on the $120,000, and it's approximately $18,360 in self-employment taxes before federal income tax. Now, let's say the same LLC, taxed as an S corporation, pays yourself a reasonable salary of $60,000 through payroll. Now that salary is subject to payroll taxes totaling 15.3%, which comes out to about $9,180. The remaining $60,000, it's taken as a distribution, and those distributions are not subject to self-employment tax. By structuring it properly, you've reduced the amount of income that is subject to self-employment tax by about $60,000, which is roughly $9,180 in tax savings legally. The IRS doesn't care what you call salary. They care whether it's reasonable based on your role and your industry and the time you spend working on the business. If you underpay yourself to avoid taxes, the IRS can reclassify distributions as wages and assess penalties. As for C corporation, that's a different level of planning involving corporate tax and potential double taxation, and it only makes sense in very specific situations. So we'll cover that in a separate video. The bottom line is this: how you pay yourself as an LLC in 2026 depends entirely on how your LLC is taxed. Default classifications use owner draws. S corporations require payroll plus distributions, and the difference between doing this correctly and incorrectly can easily be thousands of dollars per year. If you're not sure about whether your current setup is still right for 2026, the safest move is to do your tax planning review before the IRS tells you that wasn't the right setup. If this video has helped you, make sure you like and subscribe. And if you're a business owner paying yourself whenever there is money, this is your sign to put in a real strategy in place. You can contact us down below, and I'll see you in the next one.